Assalamu alaikum friends, welcome to the last part of IFRS 9, which is cash flow hedge. So in the previous part we went through fair value hedge, and this video will be talking about cash flow hedge and we'll be concluding IFRS 9 finally. So for cash flow hedge, okay, the hedging instrument will be remeasured to fair value at the reporting date. This is similar as the fair value hedge. The gain or loss is recognized in OCI. The difference comes here. Under fair value hedge, gain or loss went in the profit and loss. Here, gain or loss are recognized in OCI. This is for hedging instrument. That means your derivatives and all if you're using. However, if the gain or loss on the hedging instrument since the inception of the hedge is greater than the loss, okay, greater than the loss or gain on the hedged item, then the excess gain or loss on the instrument must be recognized in profit and loss. That means hedging instruments means the derivatives, if their gain or loss is greater than the loss or gain on the hedged item. Hedged item could be anything. For example, it could be an asset or a liability. Then that excess gain or loss, then it will be recognized in profit and loss. Otherwise, normally it is OCI. Just when you're taking the hedging instrument, the change in the fair value of the hedging instrument, that is recognized in OCI for the cash flow hedges. Okay. The questions I'll be doing at the end. All you test your understanding. If the hedged item eventually results, and to know what is hedged item and hedging instrument, refer to the previous video on fair value hedge. Okay, if the hedged item eventually results in the recognition of a financial asset or a financial liability, that means that hedged item is, okay, financial asset or a financial liability. Okay, the gain or losses that were recognized in equity shall be reclassified to profit and loss. Eventually, okay, for financial asset or financial liability, if the gain or loss were recognized in equity, shall be reclassified to profit and loss now. Okay, shall be reclassified to profit or loss as a reclassification adjustment in the same period during which the hedge forecast cash flows affect profit and loss. Example, in the period when the hedged forecast sale occurs. Because when you're having a sale forecast sales occur, in that period, it will also affect your profit or loss. The sales will also affect your profit or loss. So in that same period only you have to do this reclassification. Okay. If again, so let us repeat this again, this whole paragraph. Okay. If the gain or losses that were recognized in equity, now you have to bring it to profit and loss. You have to reclassify it into profit and loss account. If your transaction affects profit or loss, okay, it should be in the same period that you are taking in the profit and loss account. So definitely when we do a question on this, you can understand this better. Okay. If the hedged item eventually results in the recognition of a non-financial asset, if it's a non-financial asset, then what? Non-financial asset or a liability. The gain or loss held in equity must be adjusted against the carrying amount of the non-financial asset and liability. Did you see the difference between this and this? If it was a financial asset or liability, whatever the gain or loss that is recognized in equity, you are now putting it in the profit and loss. But if it's a non-financial asset or liability, you're not taking in the profit and loss account. You are adjusting that gain or loss against the carrying amount of the non-financial asset or a liability. Okay. For example, if it's a gain, you're adding that gain against the financial asset. No, sorry, non-financial asset. If it's a loss, deducting it. So this is not a reclassification adjustment, and therefore it does not affect other comprehensive income. This will not affect your other comprehensive income if it's a non-financial asset or a liability. It has nothing to do there. Only if it's a financial asset or a liability, then only you can reclassify it. Okay, make sure that you learn both this. Now we are over with cash flow hedging also, and questions I'll be doing at the end. Let us go to hedge effectiveness before that. We have been mentioning this in the earlier video, which is fair value hedge, about hedge effectiveness, hedge effectiveness. So hedge accounting can only be used if the hedging relationship meets all the effectiveness requirement. Now we are going through all the hedging requirements, sorry, all the effectiveness requirement. Okay. In the example so far, it has been assumed that this is the case. Whatever the questions we have done until now, we always assume that we have always met the effectiveness requirements, whether they tell it or not. But that's not the case always. Sometimes you might not meet the effectiveness criteria, then you cannot use hedge accounting. So according to IFRS 9, an entity must assess at the inception of the hedging relationship and at each reporting date whether a hedging relationship meets the hedge effectiveness requirement. The assessment should be forward-looking. That means in the future. You are not seeing in the past whether you're meeting or not. In the forward, are you going to meet or not? So the hedging effectiveness requirements are as follows. There are 3 requirements. If you see this list. What is it? Make sure you might not be asked such questions, but if a question is asked, what are the hedging effectiveness criteria, or for example, they might give you some scenario and they might ask you whether hedging accounting should be applied or not. In that case, you should know this criteria, this effectiveness requirement, hedge effectiveness requirement, these 3 requirements. Otherwise you will not be able to tell whether you will use hedge accounting or not, because if these 3 criteria are met, then only you can use hedge accounting. So directly they might not ask you, okay, list all the effectiveness requirement, but through another question you might have to use this as your answer, supporting answer. So in short, in nutshell, you have to learn this. First requirement is there must be an economic relationship between the hedged item and an hedging instrument. Okay. Example also they have provided. If the price of the share falls below 10, the fair value of the future contracts to sell the shares for 10 rises. Okay. Always, even I have told this in fair value hedging also, same I'm repeating again. One will fall and one will rise. It's always like that. If the price of the share falls, the fair value of the future will increase. If the fair value of the future falls, the price of the share will increase. It's like that. It's opposite always. So what is this hedged item and hedging instrument? Hedged item is the price of the share. This is the hedged item. You are hedging this because you want to protect the fair value of the share. And what are you using as, which instrument are you using to hedge that? That is known as hedging instrument. And the hedging instrument is a future contract. So future contract is known as the hedging instrument. Both of them should have some economic relationship. Can you see that relationship? This is falling by 10 and this is increasing by 10. So it is offset. Next, the effect of the credit risk does not dominate the value changes that results from the economic relationship. Okay. So credit risk is not dominating the value changes. Okay, this value changes, if you see, one is increasing, one is decreasing. It has nothing to do with the credit risk. This is happening because they have an economic relationship. They have an inverse relationship. That's why it's happening. You cannot say because of credit risk this fell down, the price of the share. No. Because we might sometimes say that because of the credit risk the fair value went up or down. But that's not true. That should not be the case. If it's that the case, then you cannot say that hedge effectiveness requirements are met, right? Credit risk can be there, could be one of the reason, but that is not the dominating reason that the value is changing. So credit risk may lead to erratic fair value movements, right? In either hedged item or the hedging instrument, it can affect anything. Either the hedging instrument, for example, future contract, or the hedged item. In this example, let's say the price of the share. For example, if the counterparty of the derivative experiences a decline in credit worthiness, what's happening? Counterparty of the derivative is experiencing a decline in credit worthiness. Their credit worthiness is going down. Okay. Because of that, the fair value of the hedging instrument, the derivative, is also falling down. But this movement is unrelated to changes in the fair value of the item. Because the fair value of the derivative is going down, that is because of the credit worthiness of the counterparty to the derivative, not because of the, it is not related to the hedged item. Okay. So this movement is unrelated to the changes in the fair value of the item. Because it is not related to the item, this will lead to hedge ineffectiveness, you see. So credit risk is not the dominating factor. Next, third one. The hedge ratio of the hedging relationship is the same as that resulting from the quantity of the hedged item that the entity actually hedges and the quantity of the hedging instrument that the entity actually uses to hedge that quantity of hedged item. Okay. Let me explain this through an example, because I definitely know most of you at this stage are now confused. Left blank. What is this? Because many times this word is repeating. Hedged item, hedging instrument, hedged item, hedging instrument. So let us go through this in example. Hedge ratio. An entity owns 120,000 gallons of oil. It enters into one future contract to sell 40,000 gallons of oil at a fixed price. It wishes to designate this as a fair value hedge. Okay, so this is a fair value hedge. And remember, all this hedge effectiveness criteria, this applies to both type of hedge. Whether it is cash flow hedge, whether it is fair value hedge, that does not matter. It will apply for both. So it wishes to designate this as a fair value hedge with 120,000 gallons of oil as the hedged item and the future contract as the hedging instrument. If deemed effective, this would mean that the fair value gain or loss on the hedged item, that is the oil, and the fair value loss or gain on the hedging instrument, that is the future contract, would be recorded and recognized in profit and loss. Okay. This would mean that the fair value gain or loss, if the oil is having a gain, okay, in the future there will be a loss. It's opposite. And if they are making a loss in the oil, they will be making a gain in the future contract. Okay. And if it is effective, then it will be recorded in and recognized in profit and loss. But however, the hedge ratio means that gain or loss on the item would be probably much bigger than the loss or gain on the instrument. Can you understand what does this mean? It means that the gain or the loss on the item will be bigger, much bigger than the loss or gain on the instrument. That means the future. There's a difference between that gain and this loss. The gain on the item and the loss on the instrument. So this would create volatility in profit or loss. That is at odds with the purpose of hedge accounting, right? That's not the purpose of hedge accounting. Hedge accounting's purpose is to reduce this volatility as much as possible. But here the volatility is increasing because the gain of the item is not same as the loss in the instrument. It's bigger. In fact, the difference is much. Therefore, the hedge ratio must be adjusted to avoid the imbalance. You have to adjust this hedge ratio. How do you adjust it? It may be that the hedged item should be designated as 40,000 gallons of oil with the hedging instrument as one future contract. The other 80,000 gallons of oil, it may be hedge item would be designated as, so the hedged item will be 40,000 gallons of oil with the hedging instrument as one future contract. The other 80,000, what about other 80,000 gallons of oil? This would be accounted for in accordance with the normal accounting rules, that is IS 2 inventory. We need to go up again. See, bring down both into same terms so that gain and loss is not too much. If you see, the oil is 120,000 versus the future is just 40,000 you are selling under the future. So make both 40,000, right? whichever is lower. Try to bring the higher amount to that amount. You definitely cannot increase this 40,000 to 120,000. Okay, but this 120,000 you can bring to 40,000 gallons of oil. So what are you doing? You are bringing this 120 to 40,000. That's what you are doing here. You are adjusting it. You see, you have designated it to be 40,000 gallons of oil now rather than 120. So this becomes the hedging. The oil is 40,000. Okay. The future contract under which you are going to sell gallons of oil is also 40,000. Both are now 40,000 because it's just one contract, right? What about the remaining from 120, 40 is the hedged item. What about the remaining 80,000? This you will be using IS2 to account for it. That is known as hedging ratio. That ratio has to be there. 1:1. That means 40,000 of hedged item versus 40,000 of hedging instrument. Okay? That's what it means. That's what you are doing here. The hedge ratio of the hedging relationship is the same. That means both has to be the same. Both has to be same. Okay? Now let us go to discontinue hedging accounting. Remember, you can discontinue also, but some conditions has to be there before you can discontinue. What are they? An entity must cease hedge accounting if any of the following occur. What is it? The hedging instrument expires or is exercised or it is sold or it is terminated. Let's say option. Option is a hedging instrument. When option is expired, you cannot use hedge accounting anymore. Or even if the option is sold or it is exercised or it is terminated, it means you have to cease hedge accounting. The hedge no longer meets the hedging criteria. Then also you cannot use hedging accounting. A forecast future transaction that qualified as a hedged item is no longer highly probable. Okay. So based on some forecast, an item has been qualified as a hedged item, but now it's no longer a hedged item. That condition also discontinue hedge accounting. So the discontinuance should be accounted for prospectively. Prospectively means you're not going and changing in the past, going from today and changing in the future. Entries posted to the date are not reversed. Whatever is done until now, earlier you have been using hedge accounting. Now you are not going to reverse it. You are going to keep as it is. But from later on, from today and in the future, you're going to not use hedge accounting anymore. That's what it means. Upon discontinuing a cash flow hedge, this is specifically for cash flow hedge. The treatment of the accumulated gain or losses on the hedging instrument within reserves depends on the reason for the discontinuation, IFRS 9 says. Okay. You must be having some gains or losses. Okay. On the hedging instrument, that means option, future and all. We are not talking about the item, we are talking about the instrument. Okay. So the treatment on that accumulated gain or losses on the hedging instrument within reserves depends on the reason for the discontinuation. Reason on the discontinuation means from reason to reason it will change. How you are going to deal with that gain and losses. It depends on the reason why you are discontinuing it. For example, the first reason is if the forecast transaction is no longer expected to occur. The gain or losses that are recognized in OCI will be then taken to profit and loss immediately. You see? If the focus transaction is no longer expected, but the second situation, that is the reason of discontinuation. That focus transaction is not expected anymore. Second one, transaction is still expected to occur, but the gain and losses will be retained in equity. In this condition, gain and losses will be retained in the equity. That means other comprehensive income already will be there until the former hedge transaction occurs. That means the before hedge transaction occurs. Okay, so you need to remember this too. So that's it for this one, cash flow hedge, and we have completed IFRS 9. But before completion and summarizing everything at once again, we have to do the 3 test your understanding. So now let us start with test your understanding. Test your understanding 19. A company enters into a derivative contract in order to protect its future cash inflows relating to a recognized financial asset. At inception, when the fair value of the hedging instrument was nil, relationship was documented. Okay, so relationship was documented. Just by the reporting date, the loss in respect of the future cash flows amounted to 9,100 in fair value terms. It has been determined that hedging relationship meets all the effectiveness criteria. So this shows that you have to use hedge accounting. Okay, you have to explain the accounting treatment for the cash flow hedge if the fair value of the hedging instrument was 8,500, B 10,000. So you can see that in A it's less than the change in the fair value of the cash flows, and in the B this is more than cash flow fair value changes, the hedging instrument. But the treatment for both are different. Okay, so let us see. The movement of the hedging instrument in A it's less, right? The movement on the hedging instrument is less than the movement on the hedged item. Hedged item is your cash flow. So therefore, the instrument is remeasured to fair value. Okay, we all know it will be remeasured to fair value, but where will the gain go? This is the main difference between the two. Where the gain is recorded, gain will be recognized in OCI. So you debit derivative because you are recognizing a derivative 8,500 and you credit OCI. B is the opposite situation. Here the hedging instrument is more than the movement on the hedged item. So the excess movement, which is 900, 10,000 minus 9,100 will be recognized in profit and loss. The balance is recognized in OCI. So debit derivative 10,000, credit profit and loss is the gain, and credit OCI 9,100, the balance from the 10,000. But the excess, the difference between the hedged item and the hedging instrument, the movement will always go in profit and loss. Okay, coming to 20. On 31st October 2001, Blink had inventories of gold which cost 6.4 to buy and which could be sold for 7.7. The management of Blink are concerned about the risk of fluctuations in future cash inflows from the sale of this gold. To mitigate this risk, they entered into a future contract on 31st October 2001 to sell the goods for 7.7. The future contracts mature on 31st March 2002. The hedging relationship was designated, documented, and all the criteria are met. 31st December 2001, fair value of the gold increased to 8.6 and the fair value of the future fell by 0.9. There is no change in the fair value from 31st December 2001 to 31st March 2002, both for the gold as well as the future contract. On 31st March 2002, you are selling the inventory at its fair value and also the future contract is settled net with the bank. You are required to discuss the accounting treatment of the hedge in the year ended 31st December 2001 B on 31st March 2002. Two different dates. At 31st December 2001, you are still having that inventory with you, but 31st March 2002, you are selling the inventory as well as you are settling the future contract. That's why the treatments are different and that's why they are on the two different dates. So first let us go on 31st December 2001, which is easy, right? We know that between this date and this date, the future contract value fell by 0.9. But at the same time, the hedged item, in this case the cash receipt, increased by 0.9 as well, the difference. Right, from 7.7 it has increased to 8.6. So if it's a cash flow hedge, this is a cash flow hedge. Where are the movements recorded? Movements of the hedging instrument, that is the contract, future contract. It is recognized in OCI. So you debit OCI because it's a loss and you credit derivative. Okay. Next, part B, when you're selling it. So when you're selling it, you'll be receiving cash. Okay, 8.6 because they told you'll be selling at the fair value and they told from 31st December to 31st March, so the fair value didn't change. So on 31st December, the fair value increased to 8.6 and it remains 8.6 only for the 3 months. Therefore, you're receiving cash 8.6. Revenue you need to credit because it's the revenue you're selling. And remember, when you bought for the first time, there was some cost which you now need to eliminate when you're selling it. You bought it for 6.4, so you need to remove this from inventory as well as cost of sales. Therefore, you're debiting cost of sales 6.4 and you're crediting inventory 6.4. Next, we are coming to record the sale of the inventory at fair value. When you're selling it, the inventory, what are you doing? Remember, derivative you have recognized here, credit 0.9, you need to debit that. Okay, so you are debiting that derivative 0.9. You are eliminating the derivative. There is no more derivative now when you're selling the inventory, and you are crediting cash 0.9. Why? Because you are in the contract to sell the goods for 7.7. Okay, even though the fair value of the gold was 8.6, but still you will be receiving 7.7 only. So the difference from 8.6 to 7.7, that difference only you have to credit from the cash, because you are selling for 7.7 only. So the balance will go. Okay, there's a decline in cash, therefore the balance only 0.9. Okay, because here you have already debited 8.6, you are receiving cash. Now you need to reduce this by 0.9. The reason is because you are selling for, you entered into a contract, remember. Does not matter at which date you are selling, but you have entered into a contract that you will be selling at 7.7. So that's why you need to credit that cash to bring it down to 7.7. Next, when you are settling the future contract, okay, you have to reclassify whatever you have recorded in OCI to profit and loss. Remember, there was a loss, right? You have that losses were recognized in OCI. Now you need to reclassify it into profit and loss. So it goes to profit and loss as debit. Before, earlier, if you see here, we had debit OCI. Now it is debit profit and loss. And now you need to take this to credit now. Okay, because that OCI amount is now reclassified to profit and loss. So you need to take it out. You have to credit OCI because it will be put under profit and loss. There will be no OCIs. So you credit OCI by that amount, 0.9. Okay, because you are reclassifying the losses to profit and loss. Why? Because through profit and loss in the same period as the hedged item affects profit or loss. The hedged item is the inventory. It is affecting that profit or loss in that same period. You have to take it to the profit and loss from OCI. Okay, now the last test you're understanding before I officially conclude IFRS 9. So the forward rate agreement has no fair value at inception, so it's initially recorded at nil. This is a cash flow hedge. Derivative has fallen in value by 10,000, but the cash flow have increased in value by 10,000. It is now 10,000 cheaper to buy the asset. That's what cash flow have increased in value means. Okay, because it has been designated as a cash flow hedge, movement in the value of the hedging instruments is recognized in OCI. Okay, for cash flow hedge you need to remember this. If it's a fair value, it is recorded in profit and loss account. There is no doubt. Okay, so debit profit and loss and credit derivative, because derivative fell by 10,000. Next, as had this not been designated a hedging instrument, the loss would be recognized immediately in profit and loss, right? If this was not for the derivative hedging instrument, in this case, if they didn't say that okay, this is the derivative and the value fell, then the loss immediately you recognize in profit and loss. But this is specially for this loss is for a derivative. Okay, that means a hedging instrument. That's why you have to take it in OCI, other comprehensive income. Okay, immediately. We are not taking about the cash flow, the changes in the fair value of the cash flow. We are only dealing with hedging instrument. That loss is or gain is recognized in OCI. Firstly, if it's a cash flow hedge. Next, the forward contract will be settled and closed when the asset is purchased. So you are purchasing the asset and you are settling this one. Okay. PP is a property, plant and equipment is a non-financial item. So the loss on the carrying amount, just okay, I'm sorry, I was just going through the answer. It was a mistake I did, I'm sorry. The question is this one. In January, the Great Own, whose functional currency is the dollar, decided that it was highly probable that it would buy an item of plant. So what is it? It's a plant. It's a non-financial asset. Remember it. In 1 year's time for this one. As a result of risk averse. So this is a currency risk. Okay. It could be any type of risk, interest risk, currency risk. It does not matter. As a result of being risk averse, it wished to hedge the risk. The cost of buying this one would rise, and so entered into a forward rate agreement to buy this one in 1 year's time for the fixed sum of $100,000. $100,000. Okay, the fair value of this contract at inception was 0 and it is designated as a hedging instrument. At Great Earn's reporting date 31st July, the KR had depreciated and the value of this one was 90,000. The fair value of the derivative had declined by 10,000. That means the forward contract. This value remained unchanged until the plant was purchased. How should this be accounted for? This is very similar to question number 20, except this is a non-financial asset. That's the only difference. That's why it will be recorded in profit and loss. Okay, so the forward rate agreement has no fair value. Okay, and it's nil. We went through this. And derivative fell by 10,000, cash flow increased by 10,000. Just okay, derivative declined by 10,000. And because it's a cash flow movement in hedging instrument OCI, so we recorded 10,000 and credit 10,000 derivative. If it's not for the hedging instrument, it will be recognizing profit and loss. And the forward contract will be settled and closed when the asset is purchased. So PP is a non-financial item. That's why the loss on the hedging instrument within equity is adjusted against the carrying amount of the plant. You see, you have to adjust the loss against the carrying amount of the plant because it's a non-financial item. That's the only difference with question test understanding 20. 20 it was a financial item, but here it is a non-financial item. So loss, you're not recognizing it in OCI, you have to adjust it against the carrying amount of the plant. Okay, so there's a liability, you need to debit the derivative. Okay, 10,000 because it will be written against the derivative. And plant 90,000 and cash credit 100,000 because you have to pay cash to purchase and you are getting a plant. Okay, just let us go through the figures again. Okay, so this is the amount of the plant you are getting, 90,000. And for how much? For the fixed sum of 100,000. You have to pay 100,000 cash. So credit cash, 90,000 plant debit, and liability is a derivative. You have to take it against the cost of the plant. That's why you're debiting it. You are debiting a liability, okay? This time this is not an asset, it's a liability. Because when you're purchasing it, you are fulfilling a liability. So your liability amount will reduce. Next, settlement of the derivative and the purchase of the plant. When you're finally purchasing the plant, you need to debit the plant, and cash flow hedge reserve you need to credit 10,000, 10,000. Okay. Why it's 10,000? When you're settling, just see. The value of the derivative had declined by 10,000. Okay. And this value remains unchanged until the plant was purchased. So you'll be getting 10,000 of plant because finally you are buying it. So plant debit and you need to credit cash flow hedge reserve. So being the adjustment of the losses held within the equity against the carrying amount of the plant, notice that the plant will be held at 100,000. How? 90 you have already debit, that's why you're adding 10,000 here because finally you should get 100,000 of the plant, and the cash spent also is 100,000. Okay, this was the position that the derivative granted. That means through using derivative, you know that exactly this much cash you have to spend and this will be your plant. Okay, so that's it, we have finished test your understanding 21. Okay, the next one is summary. So now let us summarize everything what we have covered through IFRS 9, starting with classification of liabilities and equity. So we defined what is liability, equity. We need to classify it, right? Liabilities means you have a contractual obligation to pay cash or even issue a variable number of equity instruments. Equity, there will be no obligation. Then we went through financial liabilities. How do you measure it? Either fair value through profit or loss or amortized cost. Then we went further down to derivatives, assets and liabilities. Measure at fair value through profit and loss. Okay. If it's a derivative for both assets and liabilities, and volatility can be reduced how? Just today only we finished. One is cash flow and the other one is fair value hedging. Next. We went through financial assets. Financial assets can be measured using three methods: fair value through profit and loss, fair value through OCI, and amortized cost. We completed all. Then impairment of financial assets. Those financial assets we need to impair them, right? So loss allowance, we calculated loss allowance. Okay, this is only required for investments in debt. Investments in debt. Remember that, not any investment, not in equity. Measured at amortized cost or fair value through OCI. Only for these two things we have to calculate loss allowance. Then we finally concluded it with disclosure requirements. This is IFRS 7. Okay, this separately I have covered the standard, and this all are IFRS 9 except this. This is IS 32. Presentation or classification of liabilities and equity. The rest all are IFRS 9. So here we completed the significance of financial instruments, nature and the extent of the risk, and the qualitative and the quantitative issues. So that's it. We have finally covered IFRS 9, IFRS 7 and IS 32. These are the three standards. And I have almost covered all the standards. I think I'm just left with two more standards, which is IAS 28, your associates, and IFRS 3. That is a group accounting standard. So that's it, and see you in the next video.